Joining us now, former Vice Chairman of Investments at Invesco, Krishna Memani. Krishna, good to see you this morning.
Thank you.
What do you expect in terms of earnings this coming week?
Well, so earnings are looking much better than I think most people were expecting coming into the earnings season. The bank earnings that we saw last week were extraordinarily good. I think that enthusiasm will probably fade. I think the real earnings revival will probably end up happening in the second half of the year right now, rather than right now, because the underlying economic growth is still somewhat subdued.
Yeah, what do you think is next for stocks? I mean, we're at roughly 18 times forward earnings. How much more stretch can we get for the S&P 500?
Well, so I think everything for stocks is lining up perfectly. And this is what we were expecting. The Iran thing threw a bit of a curveball, but I think all of that is getting sorted out. The drivers remain the same. Overall economic growth coming back on a global basis. Trade conflict in the rear-view mirror, and the Fed and basically every central bank in the world on pause, or I think by the end of the year they may end up cutting as well. So that's the perfect setup. I think we have to be somewhat cautious, though, from a longer-term perspective, because the biggest risk for the markets is that the overall markets do too well. Then all these, sort of things that we were talking about earlier, and bubble, asset price bubble, and all the hawks on the FOMC basically come back and put a little bit of a damper on things. But until then, it's looking pretty good at the moment.
Wait, you said that the Fed would cut later this year. Why?
Well, so I think the overall economic growth in the second half of the year is probably going to stabilize, and inflation is going to remain low. So I think they have the room to cut. Whether they will actually cut or not is something that we can do.
But you have the presidential election in play in November. Would they really cut ahead of an election? It would seem like they would be wading into a political, bonfire.
Well, I think if the Fed sees an economic slowdown, they probably end up, and especially on the inflation front, I think they will probably end up cutting even with an election season. I think the threshold has to be higher, but I think if inflation is slipping too much, which is a real possibility, I think they may actually cut.
Well, so speaking of the election, do you think that who the Democrats choose as their candidate could affect the markets if you have someone like Elizabeth Warren or Bernie Sanders, say?
Well, I think definitely. I think if the likelihood of a Bernie or Warren candidacy increases meaningfully, I think the impact on the market definitely would be substantial. Having said that, I think there's a lot of time to pass between now and then, and everything is lining up, as I said, quite well. So
even a Joe Biden would want to roll back the corporate tax cuts, that he's going to maybe not as dramatically roll back what this president's done. So is the market saying that there's no chance any Democrat wins?
Well, so I think that certainly is one possibility, but I think what the markets are saying, that the likelihood of a significant economic initiative, given the divided Congress that we have, is relatively modest. And in that environment, markets are betting mechanisms. Mm-hmm. We assign probabilities, and I don't think there's a significant probability that the overall architecture of either taxation or the growth initiatives that we have change materially irrespective of who wins.
Krishna, good to see you.
Thank you very much.
Krishna Memani.